This is the current federal tax developments for the week of June the 22nd, 2026. Current federal tax developments are brought to you by your state society of CPAs. And I'm at Zollars, and this week I'm recording on the road, which is why you see the display look a little bit strange if you're watching the video. We'll live with it for this week. I'm talking to you from, of all places, Atlantic City, New Jersey. I just finished up the New Jersey Society of CPAs conference. Did a couple of updates there. So finishing up, going to be flying back to Phoenix tomorrow, and I'm looking to get this recorded here today before I leave town. So we're going to be looking at things that happened this week in tax. Now we have 5 different things to look at this week. First, we're going to look at, because it's useful to look at these every so often, a ruling that gives relief from an ineffective S corporation and QSub elections in this case. Finally, we're going to look at a second issue that looks at procedural and jurisdictional limits in challenging IRS guidance. This is another ERC case. We're also going to look at a failure to file returns case where the IRS made estimates. So this is going to look at the Medicaid gross receipts, how they rebuild it. We're going to look at Cohan estimations because the taxpayer did get some deductions in this case, and then professional reliance. We're going to then also look at, just for fun, I guess, we got to look at a criminal case involving a CPA who, I guess in one sense, tax fraud was kind of the minor thing that went on here. Well, taxes were involved in all of it, but it was still kind of interesting. But who was trying to get out of his supervised release. And then finally, we're going to look at some transition guidance that was issued late on Thursday related to qualified opportunity zones and the changes that were made in the One Big Beautiful Bill Act. Our first ruling this week we're looking at is going to be a private letter ruling, 2026-24006. This one was released here on June the 12th of 2026. And it was a pretty standard relief from S corporation late filing, or I should say S corporation filing information. So we'll get here. So again, private letter ruling 2026-24006. Now, in this case, this is a textbook illustration of why S elections for existing LLCs are a bit high risk. You've got to be careful. LLCs have problems when trying to make them into S corporations. It can be done, but it's going to be a little more difficult than you'd expect. What happens is many people forget that standard LLC operating agreements generally contain partnership-specific language. And the big problem is partner capital account maintenance rules under 704B and profits interest. Where this runs us into problems is that under Section 1361B1D, an S corporation is strictly prohibited from having more than one class of stock. The minute it has a second class of stock, its S corporation status terminates. Or if you're trying to make an election and it already has what's going to effectively be treated as more than one class of deemed stock, that's going to make that S corporation election void from the very beginning. And that was kind of the problem we had here, because under their operating agreement, they had both given some profits interest, which are traditional in partnerships to be done, and they had, contained the 704B liquidation rules. And all of these means that effectively, if I look at each share of stock, which roughly is, we're going to do a rough calculation, and let's say, just for simplicity, each percentage of LLC ownership interest is supposed to have identical rights in distributions. Profits interest wouldn't have any rights in distribution. They'd only get profits going forward. And generally, if you have the 704B capital account information in there, you set up the possibility that distributions will not be pro rata. It doesn't matter you never had a non-pro rata distribution. That's irrelevant. The question is, could you have one? And as soon as we get to the possibility of having one, you have a C corporation. Or in this case, because they were attempting to elect, more likely they would have had a partnership. And again, they didn't want either a C corp or a partnership, so this wasn't going to be good news either way. So in this case, once and this was discovered the way a lot of these get discovered. Somebody came in, wanted to buy the entity. did their due diligence and said, you guys got this all fouled up. We don't know what should have been filed. Are there years of penalties for failure to properly file a partnership return? Are there years of penalties for unfiled C Corp? We're not going to decide this one. Go fix it. One rule I tell everybody is public companies do not generally take on messes they didn't create. They're not going to take the possibility of liability down the line for a mess they weren't involved with. So when this happens, the S corporation invariably is told, you've got to go get blessings from the IRS. And blessings are usually given, but they cost. There's a charge for filing for a private letter ruling request, right? It changes every year because the IRS sets the fees, but it's not like a $10 fee. We're talking about a 5-figure fee of having to pay to get this done. So it's not necessarily a good thing. So on date 5, this is a PLR, so we get these filled that way. The thing that wanted to be an S corporation, amended its operating agreement to align with the S corporation's single class of stock rules and canceled outstanding profits interest. Generally, an LLC operating agreement to be used as an S corporation needs to be written with the party that writes it has to have that understanding what it's going to be used for. I've worked with attorneys who use this regularly. It is something that happens in Arizona simply because there are fewer disclosures about who owns the entity that be made public if it's an LLC versus a corporation. And those attorneys that use LLCs for this purpose have a very standard agreement. They have one operating agreement they're going to use for an LLC that's going to elect S, and a very different one, standard starting one, for an LLC that's going to be treated as a partnership, right? And the one that's going to be S doesn't have the 704 discussion, doesn't allow profits interest, right? Has all kinds of things that are blocked here that unfortunately this entity not only had these in their agreement, but they also, for the profits interest, went ahead and used it, which kind of didn't work. After that, they attempted an F reorganization, transferring Y's interest to a new parent corporation with elected S status. X then filed a QSub election for Y, right? But because the original S election had been invalid from inception, Y didn't satisfy, the S corporation eligibility required to date 7. Subsequently, that QSub election failed. So this is a cascading entity tax failure, right? It's not going to work until we can go back and fix everything. Now, when you discover an invalid election, Section 1362F is the escape hatch with a fee, but it's an escape hatch, right? It does require a formal private lettering request, which is what triggers the check. We have to do a PLR. We got to send a check. In this case, the taxpayer had made several key representations. First, they proved that the failures were inadvertent. They weren't trying to pull a fast one on the IRS. They just didn't know better, right? And it can be, that often you have to, take a look, did you seek advice? Was it reasonable, the type of advice you sought? Did your advisor just foul up and fail to tell you that you had to do this differently? Sometimes advisors don't know about this, right? They also have to show, regardless, though, there was no tax avoidance motive. Now, you get a little interested about the profits interest at that point because, we usually get profits interest. Part of what's going to happen here is because quite often the ones coming in don't want to pay tax right away on the interest they got. But the IRS was okay with that. They didn't get too bad there. Then they verified that all historical tax returns were filed consistently as if the elections were valid. So they filed as S, and presumably, they basically got pro rata shares of income. That wouldn't be it. That wouldn't be a problem. And finally, all shareholders agreed to accept any retroactive adjustments the IRS might impose. And this consistency in filing is crucial. If you filed some years as a partnership, some years as an S corp, this is probably not working. Just going to say how it goes. That's why it'd be a real problem if somebody noticed the issue and then decided, well, we'll just go ahead and file as if we were an S corp because that's or a C corp because that's what we should have done. No, you have to be a little careful here. So now let's look at the technical statutory framework here, right? Regulation 1.361-1L1 provides the identical rights standard. The one class of stock rule is probably what you've heard it called. If an LLC agreement contains 704B liquidating provisions based on positive capital accounts, and those accounts are also just for fun or altered by profits interest, that identical rights test is failed. In this case, it's not just theoretical, something would have to happen, but it would then cause that. In many cases, that would be the case if it's just 704B stuff. But with profits interest, you're basically guaranteed that you're going to be having a non-identical rights in liquidation. So, true, it hadn't happened yet, but clearly it would. If we liquidated, it would happen. Now, under Section 11362F, get the right thing in there, the IRS had broad discretion to treat the corporation as an S corporation or QSub during the period of ineffectiveness, provided the taxpayer took curative steps undertaken immediately, and the ineffectiveness is deemed inadvertent. So essentially, the IRS did that. So the taxpayer established the election ineffectiveness was inadvertent, and reasonable steps were taken to cure the deficiency. Hey, gang, everything's fine. So because of this, the IRS ruled in favor of the taxpayer on both counts. Why? One company was treated as an S corporation from date 4 to date 7, and a QSub from date 7 to date 8. The F reorganization and subsequent sale were saved, but you got to think about the transaction costs involved here, the delay, PLR user fees incurred. Quite often, if the other party is probably bringing in a larger accounting firm to do that due diligence, and probably is going to insist that that accounting firm manage the PLR process. So what's going to happen is, we're not going to let the guy that fouled up and never noticed that he was filing something that never had a valid S election to begin with, and that they would argue should have figured that out the way they did. They just looked at the operating agreement. They looked at what interest had been issued and says this thing's not an S corp. Right? Should have noticed. And of course, the problem with that is that, large and national and international firms charge the fees of large international and national firms. And those usually are substantially in excess of what, the local CPA firm or the local EA was charging. But your client's going to presume that you're paying for that. In fact, and probably the courts in your state will tell you you're paying for that. So that's kind of a problem there, right? But you have to do it to clear this out. They're not going to go ahead with the buy. So the takeaway for your practice is pretty clear. Before making an S election for any client operating as LLC, you got to scrub the operating agreement. You got to do the same thing if you take over a client who's an LLC operating as an S corp. You need to do the work the due diligence team was going to do. You want to make sure that nobody can argue you should have known this wasn't an S corp, because then you just inherited the problem, right? You want to make sure that you're not taking over somebody else's problem in the same way that public company is trying to make sure they don't take over somebody else's problem. This is how they work, right? Make sure there's no partnership tax language in the agreement. Cancel or convert any profits interest to stock. That's if you're before the election is made. Afterward, we'll probably need to get a PLR. And explicitly state all distributions and liquidations will be made strictly in proportion to capital ownership. The operating agreement should state that explicitly. We are going to issue units in the LLC, and in the case of any distributions, and in the case of any liquidation, the distributions will go out, whether in liquidation or just in standard operating distributions, in the proportion of how many units you're holding to how many units are currently outstanding. We need that in the language of the agreement. And if it doesn't have that, don't get yourself in trouble by ignoring it. I hear people all the time who talk about doing a partnership, let's say a corporate return or an S corp return, and not having these documents. You seriously need these documents, because those documents are what's going to be asked for immediately if a buyer shows up. And those buyers do show up with due diligence teams. That was true the last S corporation I had, last S client I had that was purchased by a large organization. Yeah, a due diligence team showed up. right? And they had to go through, and luckily they didn't find any issues, which is good news as far as I'm concerned, right? They weren't any issues. So again, like always, we have our little illustration here. We're going to show the challenges here, the prohibited class of stock, the fact that because that meant the corporation we started with was not an S corporation, right, and couldn't be. That meant that because it wasn't an S corp, when we tried to put it inside another corporation, that meant the QSub election failed, and those governing positions killed us, right? So essentially, the tax treatment of the QSub, regardless of what the S corporation should have been, that original LLC could have been a partnership. Once we stuck it inside a corporation, then C corp is a tax status, right? That's kind of the issue. That gets us into this kind of a weird scenario there. So the pathway to relief was proactive remediation, amend your operating agreement. It was inadvertent, and they went with 1362F's authority, right, to go ahead and convert it. Next up on it, we're going to talk about First Source Employee Management, Inc. versus United States. This was a case that came down June 11th, 2026, from the Northern District of the U.S. Circuit Court, I should say, the U.S. District Court for the Northern District of Ohio. Opinion was issued on June 11th, 2026. And this is looking at procedural and jurisdictional limits in challenging IRS guidance. This is yet another attempt by a taxpayer to go after IRS Notice 2021-20 regarding the ERC. Now, I have said before, I don't like this strategy because I think even if you win, it probably, there's no remedy. The court's not going to take the next step and order the payment to be made, just because of that notice. They might say the notice shouldn't have been issued, but that's fine. It's irrelevant. The question is going to become, does the law analysis in the notice hold up? And so you can't just say, hey, this notice was issued in an invalid method. It's not a reg. And by the way, even with a reg, you still got to prove you have the best interpretation of the law. So let's go with what we've got here. So as I said, this is a case, First Source Employee Management, Inc. versus United States. Like I said, Northern District of Ohio, June the 11th. Now, this case is a lesson in tax litigation and Administrative Procedures Act. The plaintiff was Professional Employer Organization, PEO, seeking $20.2 million in withheld ERC refunds for Q1 and Q2 of 2021. To bypass the slow standard refund processing, the plaintiff filed a federal lawsuit. Again, if you have your claim for refund in and the IRS fails to act on it within 60 days, you don't have to wait for them to deny the claim. You can force the issue by going to court, and First Source Employee Management did this. But unfortunately, partially their issue was they were going to try for that quick win using Notice 2021-20, which we've talked about a number of times, a number of cases now, and it's never worked. So they did not just sue for a refund. They launched a direct attack Notice 2021-20, which IRS was using to evaluate and delay their claims. Okay, so bottom line, here we go. This suit was filed on December 19th of 2024. And obviously, they had filed their claim way more than 60 days earlier. So we're good. We're allowed to come to court. But now, what's the argument here trying to do this? So they have 4 counts they went after. Count number 1, they requested under 26 U.S.C. 7422, the refund statute, a $20.2 million payroll tax refund plus interest. Secondly, they requested a nationwide injunction prohibiting the IRS from enforcing Notice 2021-20. Count 3 alleged Notice 2021-20 was arbitrary, capricious, and unlawful under the Administrative Procedures Act. And Count 4 alleged that Notice 2021-20 violated notice and comment rulemaking under Title V U.S. Code, Section 553. And again, they sought equitable remedies, a complete wipeout nationwide for everybody of Notice 2021-20. They claim Reliance Notice 21-20 caused processing delays and economic harm, and therefore the IRS was using this to delay their claims, and for that reason, this should be gone. Now realize, delaying your claim is not the same as denying your claim. which is going to be part of our problem here. We already talked about, remember a couple of weeks ago, we now have litigation where the IRS denied a claim based on the logic of the notice, said that that was our law. And we had one court say, yep, you know what? Taxpayer, we agree more with you. We had another court same day say, no, IRS, we agree with you. And on basically the same facts. So the problem why people don't like to do that next step is because it's messy and who knows which one of those two judges you're getting, right? That's kind of our problem. So let's talk about the hurdles to getting the equitable relief, because equitable relief is what they're after, the quick win by having the notice get in here, right? So the court first analyzed Article 3 standing under the Constitution. Under established law, while past economic harm, the withholding of refunds represents an injury in fact, seeking prospective relief like a nationwide injunction requires showing a real immediate threat of future injury. But the ERC program is now a closed historical program limited to 2020 and 2021. Because First Source had no other ERC claims, it was impossible for the IRS to apply Notice 2120 to them in the future. And remember, they've now moved this thing in the district court. So we're no longer at the point where the IRS's denial, non-denial has any impact whatsoever. This lack of prospective harm completely defeated their standing to seek any of those equitable remedies. To get this thing barred forever from doing it. They're not applying it to them is irrelevant at this point. And the nationwide bars are just, no, it's not going to affect them. They have no standing. I can't litigate if I'm not harmed. I can't litigate because, well, there's somebody over here that's harmed. No, it's up to them to litigate is kind of our problem here in this case. So interesting little mess there. Okay. Next up, we're going to look at redressability and the basically Administrative Procedures Act, Section 704 statutory bar. The court went a bit further. It held that redressability also was unsatisfied because the IRS's right to the ERC comes from the CARES Act itself, the statute, not from Notice 2021-20. 2021-20 is administrative guidance issued by the IRS giving their interpretation of the law. But this is not a regulation stating that this is how the law must be applied. It is rather, a litigating position of a regular litigant, shall we say, as far as the court's going. Vacating that notice would not force the IRS to approve the refund, which has been my statement from day one. Even if you win here, and even if somehow they said that notice is invalid, you still got to go back to the CARES Act, the statute, and you got to tell me why. That's the perfect, under Loper-Bright, the perfect interpretation of the law. And that's not what we tend to see in any of these cases, because that's going to be a much tougher issue. Reality was what this taxpayer really should have done, arguably, instead of going for the home run. I mean, realize you try for anything. But arguably, this entire case ultimately will depend on whether they can carry their argument that their shutdown, likely a partial shutdown due to government orders, which may not have been directly aimed at them. If they can argue that that was the appropriate way to view it and that under the appropriate reading of the statute, they should qualify under their facts, that's how they'll win the case. But unfortunately, just getting rid of Notice 2021-20 is an irrelevant sideshow, is essentially what the court decided. Under APA 704, judicial review agency action is barred if there is another adequate remedy in court. Another disaster for them. And I've said since day one, I remember like a year ago in a tax update session, we were having a discussion. I was actually attending the session, and the issue became very simple. It's like, what can you do? What happens if the IRS doesn't act? And the answer is, well, you technically have recourse. You can go to court. Yeah, but it won't make sense financially. I said, I didn't say it was reasonable. I didn't say it was a reasonable choice. I said, but it's a choice. And that existence of that choice is going to bar you from doing most anything else. The court ruled, as I noted, a standard refund action under 7422 is the perfect, adequate alternative. Now, I may disagree with perfect and adequate, but in this case, it's kind of who cares because they're filing the suit anyway. So we're there. In a refund suit, the taxpayer can fully litigate whether that notice and its logic is valid or not. That's all we have to do, right? The APA is not intended to duplicate existing relief. And the court said, you have relief. Not only that, you're taking advantage of it right now. So we've got it. So the court dismissed the APA counts under Rule 12b-1 for lack of jurisdiction and Rule 12b-6 for failure to state a claim. Now, the refund claim, the basic send me my check, remains active. And that is the claim that got litigated in those two cases a couple of weeks ago we talked about, right? They actually litigated, and of course, one employer is apparently getting their refund and the other one isn't. You know, it's like you roll the dice, 50-50 shot, apparently, currently we know. The takeaway for if you're advising clients in ERC or other guidance is pretty clear. You cannot bypass the tax refund channel by filing a general APA suit to vacate a notice unless they face ongoing regulatory exposure under that notice. If this was a going forward issue, they might have been let in the door. If the ERC was still around, they could still qualify for it. It would apply to them in the future. That's it, right? All the other administrative law arguments must be litigated within the safe, established harbor of a statutory refund action. You had your adequate penalty, right? And so again, we have our infographic. It's on the slides if you download them, right? It's on the screen if you're watching the video. And yes, I know the video looks weird. Somebody's going to notice that now. But that's because I'm having to record on one screen. I don't have my second screen I normally use for recording because I'm in Atlantic City, New Jersey, and that second screen is in Phoenix. I didn't feel like dragging it along, right? You know, and explaining why I have a big monitor coming with me. So we did that. So that was kind of our background. The next case up is a case of Branch versus Commissioner, Tax Court Management Decision 2026-51. Case came down on June the 17th, 2026. And again, TC memo, Tax Court Memo Decision, so 2026-51. So let's talk about our case here. What's going on here? This case is a clinic on substantiation, procedural missteps, and the limits of professional reliance. In this case, the taxpayer, Colette Branch, generated millions in revenue but failed to file returns for 2015, 16, and 17. Amazingly, that might be a problem, which it was. And she got them from Medicaid program from the state of Louisiana. Do you believe Louisiana filed those 1099s? Yeah, okay, it's a problem. Now, the IRS prepared substitutes for return under Section 6020B and hit her with massive deficiencies and failure to file penalties. Not surprising. So the total looking at here is over $1.8 million. That's what we're doing. Now, a procedural battle occurred at trial. And this is where the IRS fouled up. Right? The IRS tried to bolster its arguments in its post-trial brief by using Google Maps Street View photos of property and Yelp's review of restaurants, asking the court to take judicial notice of things on those, right? The tax court flatly rejected this under the Federal Rules of Evidence, Section 201B. The court reminded the IRS that internet reviews and map images are subject to reasonable dispute and cannot simply be judicially noticed, right? If it's something that's unquestionable sources or generally known facts. It said this is neither of those. You know, Paulette should have had the ability to know this was coming and the ability to dispute what you're giving me. I'm not going to let you sneak it in later when you didn't bring it in as evidence properly to begin with, right? So this didn't meet the stringent standards. And if the IRS wants to use this procedure, they must formally introduce it at trial, not introduce it quietly in the post-trial briefs. Right. You know, you're supposed to present your arguments up front. Colette had no right to look at this, challenge it. The court's going to ignore it. So the IRS fouled that up, and it was an attempt to get rid of some other, deductions by probably, claiming whether, it's tough to know what they're claiming based on Street View and other things, proving where something was, pictures, might have been showing that, a place was closed, unused, might have had Yelp reviews telling you that this thing closed down on a certain date. All of these things happening, we don't know what was there, but in any event, the court said, Iris, you wanted to use this, you had to bring it in earlier. Colette had to have a right to know about it. You didn't let Colette know about it, it's tough luck. Now, however, we go through a few others, right? So there's two critical warnings now. We're going to talk about filing status pitfalls and pretrial stipulations, right? Joint filing requires a signed joint return. Okay. Now, her husband, basically, she prepared draft returns to go in, right, with the filings, but the drafts were marked do not file, and that's useless, right? That had a signature issue in there. It doesn't matter, right? You got to actually file a joint return. Secondly, in her answering brief, it turns out that the IRS wasn't the only one to not raise an issue in a timely manner. She tried to argue for 50% of the income should go to her husband if we're going to do a separate return under Louisiana's community property laws. Now, the court rejected that community property defense, saying it was abandoned. It was raised too late in the proceeding. Again, the IRS didn't know about this argument because they could have argued, that he failed to cooperate, didn't provide her with stuff. They could have investigated into all of that, but she raised it so late that now they're saying, Colette, what's good for the IRS is good for you. You also raised this too late stuff. Done. Right. And conversely, though, the IRS held the court held the IRS strictly as pretrial stipulation. They wanted to reduce her contributions to the Curtis Christian School to only 50%, again, because of community property, because that had come up. They said, nope, you're not allowed to walk back that concession. You'd already conceded it to force 50% community property limits. The fact that she just mentioned it, had she mentioned it timely, the IRS would have probably raised this too. But it's like, but no, but both you guys, you wanted to raise, either one of you could have said community property. It's not exactly some sort of unknown fact that Louisiana is a community property state. Hopefully, especially the attorneys with the IRS were aware of that. So, you should have raised this issue earlier. You didn't. So tough luck. Now let's go on and let's take a look at this. Essentially, we're going to be talking about in this case, are ordinary and necessary expenses and strict substantiation. So we're going to bring up the wonderful Cohan case and Cohan rules. Okay. Now, under Section 162A, you can have ordinary and necessary business expenses. Now, the court looked at some of her stuff and decided, right? Can you, can't you? Right? Why are you going to be able to do that? Right. Now, some personal care, you can't deduct personal care items, food and clothing, but because she was running, a home, right, for Medicaid, kind of, a long-term care home for Medicaid patients, they're saying, well, she's going to need food and clothing for the people in there. So that kind of purchases, even though they're on, the receipts we're seeing, and, no, it's reasonable. She has to have that because she has to provide that per the terms of her agreements with the state, right? And also, she didn't have perfect records, but they could use it based on if they have a reasonable ability to do so under the Cohan rule, which was a case from, George M. Cohan versus Commissioner, the Second Circuit case from back in the 30s. They said, look, if it's obvious expenses would have been incurred for this, she's running a nursing home type structure, care facilities, like she has to have food there for them, right? She'll need clothing for them. It's basically like these are obviously things she needs to provide under her contract with the state. So she had to incur those costs. We have a way to reasonably estimate, we believe, from what she provided so far. So we're going to allow those expenses. However, there is the 274D problem here, right? And we'll talk a little bit about that. Under the 274D, overrides Cohan, but for travel, gifts, entertainment, and listed property in this case, right? Now, and one other thing under personal care, and I should have mentioned this, that was allowed in all this, she was deducted rent for a Houston apartment in full. And the court found it credible that a New Orleans business needed a Houston site in case of hurricane evacuation. Remember, we actually had that little problem in Louisiana back in 2007, was it? Yeah, 6 or 7. Got to remember when Katrina hit. So the court was okay with that. But when we get to travel, gifts, entertainment, those are all going to be disallowed, right? So while we could estimate utilities and contracts, we couldn't get any of these others. Also, Her rent for her husband's restaurant and a vacant New Orleans apartment were disallowed. They said he didn't provide us any reasonable connection of those, how they'd work. Her husband's restaurant, it's a restaurant. It's not providing this care facility. We're not going near that. And the vacant New Orleans apartment, there wasn't really any realistic evidence of how that was ever going to be used inside of the care facility structure. And contract labor and utilities were allowed at about 70% of what she claimed, applying Cohan estimates to them. So that's how we got that. Next up is we have the uncategorized credit card trap and the defeat of audit delay. Okay. Now, first, providing raw credit card statements with no business categorization results in 100% disallowance. For 2 of the 3 years, she had no characterization. She did have some characterizations for 2015 on the Amex cards, but she just had total Amex. Yeah, just because you put on your Amex card does not prove it was a business expense, especially because it was already known from the prior year there was a mix in there. Right. That was kind of how it works there. Okay. Second, she tried to claim an audit delay defense. Right. She claimed her bookkeeper advised her delayed filing because the prior was under audit. And she said, and I relied on my bookkeeper to tell me this, right? Well, what happened there was the court cited Boyle. That was a Supreme Court case that stated that taxpayers must timely file return using the best information and amend later. And it's presumably everybody knows they're supposed to pay taxes. And everybody knows they're due by April 15th, right? Or on extension, October 15th. And just ignoring them because you're under audit, the court said, we're not about to grant everybody in the U.S., the minute they have an audit, the right to stop filing returns. That's not how it works. That's going to go. And third, statements, basically FSR, the substitute for returns, do not count as return for the prior estimated tax safe harbor. You don't have one. And that was the third problem that she had under her case. So, not a good day for Colette generally, but we're there. So some reminders of key aspects of this are on the infographic. Remember, Cohan estimation can work if you have a reasonable estimate, but you've got the 274D problems. So travel, vehicles, all that sort of stuff. Yeah, that has to have substantiation with strict logs. Credit card, need records besides simply I put down my American Express. That's not going to make it work. And finally, please remember whether things are ordinary or personal. Generally, ordinary and necessary business cost, clothing for her clients, various other things. Certain things were done. Client meals were good. Even though they appeared personal, she had to provide those. She had to provide the clothing for the clients, some special ones for the presentation. So they allowed those, which was kind of nice of them, honestly. Unreported receipts and deficiencies, she did not challenge the receipts. So she agreed that she had received well over $6.5 million each year, or well, in one case, barely over, but still over $6.5 million every year and nearly $6,800,000 in 1 year. And audit delays are never reasonable cause, right? The fact you're under audit does not mean you can stop filing returns. The IRS can't walk back resolved issues if it prejudices taxpayer. And you can't invoke new things for the first time. In this late claim in answering briefs, I mean, that's it. Her community property claim was simply raised too late. Next up, let's talk about some good old criminal tax work or criminal taxes involved in this case. This is a case of the United States versus Royce, right? This case comes from the Middle District of Pennsylvania, U.S. District Court, from June the 16th, 2026. So let's take a look at this. This decision involves a former CPA. You notice it says he was a licensed CPA operating a tax controversy practice, right? Okay. And he used those credentials to really advance a fraud. Now, he took over a deceased accountant's practice, and he basically didn't tell the clients that the person had died, just his office had been relocated. But he also said that things were changing, and because of that, he demanded being paid in cash. Right? He told clients the IRS was offering a one-time debt discount. You can get your money today. Isn't this wonderful? He'll do it. He instructed clients to write checks directly to him personally, totaling $187,522. At least some didn't have that lying around in cash. He defrauded one particular client, David and Carol Gifford, of $196,723 by promising a 10% discount on an over $200,000 liability. I altered e-filed returns to generate refunds and divert them to his own business account. So, clients are told they owe this big money. He prepares returns claiming refunds. He pockets the refund, and he pockets the money the client gave him. What a deal, right? And then he also deducted $110,000 in unauthorized preparer fees from other clients' refunds. Nice guy. Okay, well, all good things must come to an end, and eventually everything came crashing down on Mr. Royce, right? In this case, the scheme unraveled when banks sent refund disbursement details directly to taxpayers. Refunds they'd never seen, had no idea what they were. What does this mean? I got a refund. No, I gave that guy 200 grand. No, refunds have been issued. You can imagine this isn't good, right? So IRS CID comes in, right? The guys with the guns. Now, 6 days after he was notified he was being probed for this fraud, he returned $110,306 to the IRS, and he falsely claimed theft of his electronic filing number. Okay. All of these sorts of things came in. And then he and his wife went on and purchased a $518,000 home in Orlando, Florida, using the stolen funds. Remember, he only gave back $110,000. Shortly after this, his wife filed for divorce, the purpose being to get the house transferred to her in her name, not in the name of Mr. Royce, right? So, basically the IRS then, and the courts could try to take that back from him. And then quietly and secretly, they remarried within a year, okay? Now, the intended loss of the tax and mail fraud scheme was calculated at $454,053. Mr. Royce pled guilty and was sentenced in January of 2023 to 46 months in prison and 3 years of supervised release. Okay. Now, the catch was we weren't done with Mr. Royce and what he was up to. I mean, if why give up when you're losing? So he did. He became to be what would be known as the malingering defense, right? He asserted he didn't understand why he was in court or the charges, right? He filed a notice of mental health defense delaying the trial for 3 years. He underwent extensive psychological evaluation by defense and government experts. These evaluations concluded he was actively malingering, faking his cognitive defects. And he overdid it. He turns out not a good actor. He demonstrated exaggerating speech defects using childlike and caveman speech in exams. He had normal MRI results. He remembered complex non-legal information. He simply became an idiot when anything related to this came up, right? And at the end, trying to reduce his sentence, he submitted a lengthy, highly eloquent letter that to the court prior to sentencing. It kind of demonstrated he was very, very much did not have a mental health defense issue, right? He understood everything. That's going to come back to haunt him when we get here to this case. Okay, fast forward to today. He served 1 year of supervised release, and he petitioned for early discharge under Title 18 of the U.S. Code, Section 3583E1. Now, the sentencing courts weigh factors under that section under Title 18 U.S.C. 3553 to evaluate early discharge. Now, the primary purpose of supervised release is meant to be societal integration, not punishment. Right? Under the Third Circuit Melvin precedent, extraordinary circumstances are not a strict requirement, but early termination requires new or unforeseen circumstances. That is, sentencing judges expect that something must have changed to justify cutting the period short. Right? And the key issue here is supervised release is not meant to be a punishment. That's not the point. And complying with your terms of supervised release is not going to gain you favor. Now, not complying will be a big negative, but the minimum you're expected to do is comply with your terms. Right? This is what we're using. Now, of course, Mr. Royce argued that his positive prison record, clean drug screen, and compliance with all rules was a reason why they should terminate his, supervised release. Now, the court said, look, you just did the minimum you had to do. That's what you agreed to do. And that, and being that we believed you would do what you agreed to do, we sentenced you to 2 years here, okay? Not 1, right? And the court said, it's not exceptional behavior. It's just what we expected. And we have concerns. Your prior malingering and courtroom deceit analyzed as permanent indicators of risk that you would do this again if you got a chance. As soon as it became clear you weren't getting away with, telling the court you were mentally unstable, didn't understand the situation, and then you suddenly snap back to being, now come back in and be very apologetic, etc. And do this. It's like, yeah, we don't really think this, right? Intentional, non-addictive fraud schemes carry high rates of recurring dishonest behavior. If he was back in a position when he could do it again, the court's concerned he would do it again. If he convinced himself he wouldn't be caught. Active supervision, therefore, remains necessary under Section 3553A, 2, B, and C for deterrence and public protection. Now, he claimed that he had travel barriers because he was trying to become a PGA Tour caddy career, and also attend his daughter's school functions outside of state. The court said, you never showed us when they were turned down, and they might be administratively inconvenient, but you hadn't really demonstrated the real harm here. And, I'm sorry you stole all that money, right? You have to put up with the fact that we're not going to fully trust you without question. That's what we expect from you. So again, we have our nice little bar here on early termination. This is the lessons from United States versus Boyd. So hopefully none of you are ever facing this, but if you are, understand why Mr. Royce didn't get out early, right? Just like I said, he did the minimum necessary. Also, as bad as it is, yes, there are CPAs and EAs that will take advantage of situations like this. There are fraudsters in every profession. The fact that you could pass an exam doesn't necessarily mean that you're the world's most upstanding person, and that you're not somebody who believes that, well, if I can get away with it, it's fine. And unfortunately, it kind of appears that he felt that was the case. Not great. Finally, the IRS basically on Thursday issued IRS Notice 2026-40. So this is transition guidance on the OBBBA changes to qualified opportunity zones. Now, the original qualified opportunity zone rules were enacted under the Tax Cuts and Jobs Act in 2017. They were amended by the Bipartisan Budget Act of 2018, which is not the one that gave us the partnership BBA rules. We just have multiple BBAs, right? But they were substantially modified this past year by the One Big Beautiful Bill Act on July 4th of 2025. Now, this provides a number of critical post-OBBBA transitional guidance because they went in and changed rules, changed wording, and didn't worry about the fact that they were stripping out wording that was necessary to complete the TCJA cycle of this program. So this is really dealing with wording that's missing and saying, well, what they really meant was if you came in under the TCJA program, then we're going to test you under the terms there. If you came in under the non-TCJA program, you came in after, the time you could acquire the TCJA stuff, then you're going to be tested under the new program, right? So, because what happened was the One Big Beautiful Bill Act struck December 31st, 2017, and replaced it with the term applicable start date for the beginning of the time period. It's going to run to where we can defer the gain, keep from recognizing the gain we put into the fund until that date. And older, the TCJA era zone programs face expiring 10-year designation periods coming up here very shortly. Okay. Now, IRC Section 1400Z-1D restricts designated nodes to 25% of a state's low-income community. And OBBBA amended this limitation to apply to during any period. Now, this is any period refers to the specific 10-year designation period. Previously designated QOZs do not count against the state's 25% cap for the new period. The law, you could read an overlap here that would have denied, the new ones couldn't get in there. So states can now nominate a full complement of tracts effective January 1st, 2027. And these new designation periods will run from January 1st, 2027 through December 31st, 2036. Right? That'll be it. And then there'll be another one that will start up in January 1st of 2037. Now, taxpayers who deferred gains under the prior rules, they're going to recognize that remaining deferred gain on December 31st of this year. Remember, that's coming up. This deemed included gain must be reported in gross income in 2026. Right? Importantly, recognition of this gain does not terminate the underlying deferral elections. Right? So they remain fully eligible if they hold on the property for a 10-year fair market value basis step upon sale. Again, they bought under the old rules. We're going to apply the old rules all the way through. Now, one big caveat, though, is that deemed gain. So let's say your client back, right as soon as they could, bought into a qualified opportunity zone because they had a $300,000 gain. Right, a $300,000 capital gain. They put into an opportunity zone fund. And, they have that. They're now going to recognize, 70%? I think it's what we got this year. I had to go back and remember that. They're going to recognize a portion of that gain this year, right? The amount they didn't get the basis increases for. Well, the problem is, of course, that gain, that's a capital gain. Can't I, within 180 days, put that gain into a new investment and defer it? The answer is no, right? Gain realized in 2026, but invested post-2026, in that case, enjoy a new shifted 5-year inclusion date, those new gains. So that's going to be, remember, the rules change. There's no longer going to be a fixed date. You're going to recognize the gain 5 years from the day in which you invest in the fund under this rule. So property bought after December 1st, 2026 in older zones is disqualified under the general rule. Right? There is one exception. Working capital plans adopted on or before December 1st, 2026 are fine. Working capital plans must meet a 10% receipt, 5% expenditure metrics by December 31st, 2026. And then number 2, ordinary course replacement or modernization of existing building property. Replacements are allowed if necessary to continue the current trade or business operations. We're going to basically upgrade that property. Ordinary course replacements strictly exclude business expansion or transition into new fields. It's got to strictly be to kind of nurse it along until we get to 27, when we can then qualify as our opportunity zone investment. Now, older zones expire on December 1st, 2027 for Puerto Rico, or December 31st, 2028 for all others. Expired designations would technically trigger immediately compliance failures for QOFs and QOBZBs. The 2026-40 creates a dual post-expiration safe harbor extended through December 31st, 2047. Substantial use safe harbor. Expired zone are treated as active for the physical asset use test. And the qualified opportunity zone business compliance safe harbor. Expired zones are treated as active for the 50% active gross income test. You must have begun active business in the zone or have a valid pre-2027 working capital plan on or before the expiration. So, navigating the cliff. Right. Again, we have the 2026 income event coming up. Remember these issues, right? The fact is that if you bought into the first program, the fact they changed all the wording is not going to mean you can't get your full, basically exclude the gain if you sell after you hold it for 10 years, right? So essentially, potential step if you have for 10 years. Now remember, after we get to post 26 investments, you basically get the deferral for only the 5-year period. However, you get up to a 30% step up in basis, right? Pick it up in income though after 5 years, and then you can carry that forward. And again, keep doing it. Now, compliance safe harbors for old zone. Property acquired post 2026 qualifies if pursuant to a written plan adopted by 12/31/2026. Replacement modern existing premises businesses are replaced as permitted. Acquiring property for expansion old zones is not permitted, and qualified entities may treat expired zones as active through 2047 for operational testing purposes. Well, this has been the current federal tax films for June 22nd, 2026. I should be back to my regular size screen next week because I'm not heading anywhere. I'm going to be doing a couple of sessions, one for Oregon and one for a group of EAs. So I'll be doing those things, and one for Arizona, actually a 2-hour for Arizona in that case. So I got a few things happening next week. But, we'll be looking at those. Again, if you have any questions, you can email me at zollars@currentfederaltaxdevelopments.com. I'm a member of the Arizona and New Jersey Society of CPAs. I am Minnesota, Illinois. I monitor Connect sites for those states. I monitor for Idaho as well, and Washington. So I got all of those. So if you post a question on those sites, if I can, I'll see if I can answer. If I notice a question, I think I can be helpful. But otherwise, we will hopefully see you back here next week when I'm back in Phoenix. And we'll take a look at what happens in the coming weeks for current federal tax developments.